Welcome to the Owner's Playbook, the podcast for visionary business owners who are building something bigger than themselves. I'm Carol Dewey, founder of Claris Advisory Partners and creator of the Navigator system. Each week, we help business owners increase the value of their companies, reduce unnecessary risk, create more personal freedom, and ultimately exit on their terms. Today, we're going to tackle a topic that might make some accountants uncomfortable, but it is a conversation every business owner needs to hear. The title of today's episode is Why Your CPA May Be Great at Taxes, but Terrible at Tax Strategy. Now, before anyone starts sending me angry emails, let me be clear. This is not an attack on CPAs. In fact, many of my closest professional relationships are with outstanding CPAs. Some of the smartest people I know are accountants. The problem isn't that your CPA is bad. The problem is that most business owners expect their CPA to do something they were never hired to do. And that misunderstanding could be costing you tens of thousands or even hundreds of thousands of dollars over your lifetime. So let's dive in. Most business owners believe taxes and tax strategy are the same thing. They're not. Not even close. Think of it this way. If you went to a doctor after having a heart attack and he successfully kept you alive, you would probably consider him a good doctor. But wouldn't you have preferred someone helping you avoid the heart attack in the first place? That's the difference between tax preparation and tax strategy. Tax preparation tells you what happened. Tax strategy influences what happens. One looks backward, the other looks forward. Most business owners spend thousands of dollars every year preparing tax returns. Very few spend meaningful time developing a tax strategy, and that's where the opportunity lies. So let's talk about reality. Most CPA firms are overwhelmed. They're managing hundreds of clients. Some are managing thousands. During tax season, they're working insane hours simply trying to keep up. Their primary responsibility is compliance. They need to prepare returns, file forms, meet deadlines, respond to IRS notices, and ensure accuracy. Those responsibilities are important. In fact, they're critical. But none of those activities necessarily reduce your future tax burden. They're focused on reporting history, not designing your future. That distinction matters. Because if your advisor is spending all of their time documenting what already happened, who's helping you structure what happens next? Here's what I see repeatedly. A business owner works incredibly hard. Revenue grows, profits grow, the business becomes successful. Then every April, they receive the same unpleasant surprise, a large tax bill. The owner gets frustrated. The CPA explains why taxes increased. Everyone agrees it wasn't ideal. Then they repeat the process again next year. Nothing changes. The cycle continues. What I find fascinating is that business owners would never run their operations this way. Imagine waiting until December 31st to create your annual business plan. Imagine waiting until after an employee quit before creating a retention strategy. Imagine waiting until after losing a major customer before discussing sales diversification. Yet that's exactly how many owners approach those taxes. They wait until the event occurs before discussing solutions. By then, many opportunities are gone. There is a phrase I hear constantly, and it sounds innocent, but it can be incredibly expensive. The phrase is, I didn't know that. I hear it after business sales. I hear it after property transactions. I hear it after retirement plan decisions. I hear it after liquidity events. I hear it after succession planning decisions. The tragedy is that many of these tax mistakes were completely avoidable, not because anyone was negligent, but because nobody was asking strategic questions early enough. Taxes are often determined long before the transaction occurs. That's why timing matters, planning matters, and proactive conversations matter. So what exactly is tax strategy? Tax strategy isn't about finding loopholes. It's not hiding money. It's not gaming the system. It's not aggressive tax schemes. Good tax strategy simply means understanding the rules well enough to legally position yourself more efficiently. It means asking questions like, how should I pay myself? Am I using the right business entity? Are my retirement plans optimized? How should I structure a future sale? What tax consequences exist if I bring on partners? What happens if I die unexpectedly? How can I transition wealth to my family more efficiently? Those are strategic conversations. Those conversations should happen before decisions are made, not after. I've noticed business owners generally fall into 4 different categories. Stage 1, tax victim. These owners simply pay whatever tax bill arrives. They don't understand it. They don't question it. They assume nothing can be done. Stage 2 is tax aware. These owners understand taxes impact their wealth. They start asking questions. They're curious. They're looking for opportunities. Stage 3 is tax strategic. These owners actively plan throughout the year. They review decisions before executing them. Taxes become part of every major business discussion. And stage 4 is tax integrated. This is where the most sophisticated business owners operate. Tax planning isn't separate from business planning. It isn't separate from estate planning, and it isn't separate from investment planning. Everything works together. This is where truly meaningful wealth is often created. One of the biggest surprises for many business owners is discovering that income alone doesn't create wealth. I've met owners making 7 figures annually who have surprisingly little financial independence. Why? Because income is only one side of the equation. What matters is what you keep, and what you keep is heavily influenced by taxes. 2 business owners can earn exactly the same income. One ends up financially independent. The other remains trapped on the treadmill. The difference often isn't revenue. It's efficiency, it's planning, it's execution. Inside the Navigator system, we don't start with products. We don't start with investments. And we certainly don't start with tax returns. We start with objectives. What are you trying to accomplish? Do you want to sell your company? Pass it to family? Create passive income? Reduce taxes? Protect assets? Retire early? Fund a legacy? Once we know where you're trying to go, we can begin identifying potential obstacles and opportunities. Taxes become one component of a larger strategy, not an isolated event that shows up every April. Because the reality is this: every financial decision has tax consequences. Every business decision has tax consequences. Every estate planning decision has tax consequences. Ignoring those consequences doesn't make them disappear. Here's the question I would encourage every business owner listening today to ask their advisors. What tax planning opportunities should I be discussing now for the next 3 to 5 years? Not next month, not next quarter, 3 to 5 years. See what happens. You may discover your advisors are already having those conversations, and that's fantastic. Or you may discover nobody has been looking that far ahead. That realization alone can be incredibly valuable. As we wrap up today's episode, remember this: a great CPA is incredibly valuable. A great tax strategist is incredibly valuable. The best outcomes often occur when both work together. This isn't about replacing advisors. It's about expanding the conversation. The most successful business owners don't build teams of specialists working in isolation. They build coordinated teams working toward a common objective. Because the goal isn't simply filing accurate tax returns. The goal is creating the life, business, freedom, and legacy you want with the resources you've worked so hard to build. And that's a much bigger conversation than taxes alone. Thank you for joining me for another episode of the Owner's Playbook. I'm Carol Dewey, founder of Claris Advisory Partners and creator of the Navigator System. If today's discussion made you think differently about how taxes fit into your overall business strategy, I'd encourage you to subscribe, share this episode with another business owner, and continue following the show. Remember, a successful business doesn't automatically create personal wealth. A valuable business doesn't automatically create financial freedom. Those outcomes happen through intentional planning. Until next time, keep building your business with purpose, protect what you've created, and always play the long game. This is the Owner's Playbook, and we'll see you on the next